Welcome to the Empire Business, where we dive deep into valuing startups and private companies, venturing beyond the familiar realm of public markets. The typical question often arises: how do you truly value a private company? It's a question far more complex than valuing a public one. Unlike public companies with readily available market data, private company valuation is more art than science. It demands a nuanced approach. To understand the different types of private businesses, let's use a compelling analogy from Breaking Bad. Just as Walter White evolved his business, understanding the type and scale of a private business is crucial for valuation. We categorize private businesses into three distinct types: money businesses, meth businesses, and empire businesses. First, money businesses are stable, cash-generating entities with typically lower growth. These businesses, like local services or retail, are often mature and valued heavily on their consistent cash flow multiples. Next, meth businesses are characterized by high growth, often disrupting markets but may not yet be profitable. Think early-stage tech startups. Their valuation relies on revenue multiples, growth-adjusted projections, and market comparables. Finally, empire businesses are large, established, diversified, and strategically significant. These businesses influence markets and create strategic value beyond just revenue. Valuation considers strategic premiums, synergy potential, and long-term growth. The crucial insight here is that the type of business dictates the most appropriate valuation methodology. This fundamental difference is why a, quote, one-size-fits-all approach simply doesn't work for private company valuation. For money businesses, traditional discounted cash flow, or DCF, and cash flow multiples are often the most effective. Meth businesses typically call for growth-adjusted multiples or venture-style approaches, given their high growth and often negative cash flows. And for empire businesses, strategic valuation and comprehensive scenario analysis are paramount to capture their broader market impact. Before applying any valuation method, normalizing financial statements is critical for private companies. One key adjustment is normalizing the owner's salary to market levels to accurately reflect operational expenses. It's also essential to remove non-recurring, one-off costs or gains that distort the true financial picture. Additionally, normalize discretionary expenses such as personal perks paid by the business to reflect only operational costs. Correcting for accounting choices that might distort true cash flow is another vital step in this normalization process. In essence, normalizing financial statements for private companies involves adjusting for anything that isn't a core, repeatable business expense or income. Adjusting owner salary and discretionary expenses provides a clear, comparable view of the company's financial health, crucial for accurate valuation. Now let's explore valuation method differences and a critical concept: the illiquidity discount. We introduce the illiquidity discount, typically ranging from 10 to 30%, to reflect the difficulty of selling private company stakes compared to public ones. For money businesses, given their stable cash flow, the illiquidity discount is usually at the lower end, closer to 10 to 15%. Meth businesses, with their inherent high growth and uncertainty, warrant a higher discount, typically between 20 to 30%. For empire businesses, the discount can vary significantly, depending on the strategic demand and market influence they command. While powerful, the discounted cash flow, or DCF, method presents unique challenges when valuing private firms. Estimating the weighted average cost of capital, or WACC, is problematic due to the lack of observable market data for private companies. Predicting perpetual growth or an exit multiple for terminal value is inherently speculative, adding another layer of complexity. Cash flow volatility, especially for high-growth or smaller firms, makes standard DCF less reliable without significant adjustments. The problem with calculating WACC for private firms stems from the absence of public market information, making it difficult to determine accurate betas and cost of equity. The difficulty of estimating terminal value reliably means relying on projections far into the future, which are often prone to high subjectivity and error. Despite these challenges, there are practical solutions to make DCF a viable tool for private company valuation. For WACC, a practical solution involves using the median capital structure of comparable public companies, adjusted for private firm risk. Different methods for terminal value include discounting future free cash flows, projecting cash flows for a finite period, or using liquidation value for distressed assets. Let's examine a real-world example of Empire Business strategic valuation, the merger of Kakao and Daum. This case study exemplifies how strategic valuation can go beyond simple financial metrics. The strategic rationale of combining Kakao's mobile dominance with Daum's web portal created significant value beyond their standalone cash flows. This illustrates combining traditional DCF with crucial strategic valuation adjustments to capture the full picture. It shows how synergy and enhanced market positioning can justify premium multiples, revealing value often missed by standard approaches. To summarize, let's look at the key takeaways and core principles for valuing private companies. Remember, the business category money, meth, or empire fundamentally drives the valuation methodology you should use. Always normalize financial statements for accuracy and comparability. This is non-negotiable for private company valuation. Don't forget to apply appropriate illiquidity discounts to reflect the unique realities and risks of the private market. Use multiple approaches, DCF, comparables, and strategic adjustments to triangulate value and gain a comprehensive perspective. Finally, Empire businesses demand a strategic and market-influenced valuation, looking beyond mere financials to their broader impact.